The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
And welcome to Volatility Views. Whose voice is that? This is not Mark Longo. This is another Mark. A better looking Mark. A smarter Mark, if you will, according to my mom. This is Mark Sebastian. And welcome to Volatility Views. With me is, of course, the great Don Schlesinger. How are you doing, Don?
Well, it's great to be back. I know it's been quite a long time. Listeners might know that I had some family business to attend to in France, and now that I'm back, I'm raring to go. But I want to take a moment to thank Bob Kraus, the CEO of the Volatility Exchange, who stepped in and did a couple of shows. And from some of the listener mail that we're getting, I see that they went over very well. So thank you to Bob, and it's good to be back.
Oh yeah, it's like, but you know, he did an admirable job. But you can't replace Michael Jordan. You can't replace Don Schlesinger. That's basically what we've been dealing with for the last couple of weeks in your absence, Don. So
well, now I have nowhere to go but downhill, right?
Oh yeah, right, right. I think not. No, it's great to have you back, and you know, we did have some really good shows, and you know, I can't wait for you to get the time to really dig into the show with Sharias. We're going to have lots to talk about when you finally get a chance to dig into that one.
Yes, I'm going to catch up, and perhaps as in the past when we've had some topics that have stirred up a lot of interest and questions, they've actually dragged on for several weeks down the road and provided a lot of food for thought. So I have a feeling that, judging from the feedback, we might be discussing that show for a few weeks to come, and that'll be great.
Yeah, I mean, I think it should be something it will end up being something we discuss a lot, and will be maybe a little less redundant than some of the stuff than our Talib Groundhog Day we got stuck in last year.
Good.
But with that, now that we've got our chieftain back, let's move out of our welcoming block and into the Volatility Review.
It's time for the Volatility Review.
And welcome to the Volatility Review. This is obviously where we're going to talk about, well, what's been happening in volatility. You know, I'm going to pitch it to myself first. We're going to talk about VIX a little bit. You know, that was, you know, we got a couple of interesting things going on in VIX, Don. Had quite the nice spike up last week, made a real close charge at the Italian highs from February. Although, interestingly, you know, we had 2 days last week where movement, realized volatility, was almost as big or bigger than what we saw out of the Italian elections. And yet the VIX failed to, you know, move higher than where we got in Italian elections. I think it kind of points to whether, you know, the fact that maybe we did actually have a little bit of a run on VIX futures and, you know, VXX back in February. And this was more of an orderly move. But, you know, interestingly, I do think the VIX has found a bit of a floor because S&P realized volatility the last 20 days, 14 and 3/4.
Yeah, I've got 1406 for 21 days, considerably higher for the NASDAQ now, inching up into the 17 handle. So that spread that we talked about more than once and that I recall was very close to even or maybe +1 for the NASDAQ has now widened out to just about +3 or so, which is probably more in keeping of what it should be like historically, but interesting to note that while I was gone, it did seem to widen somewhat.
Yeah, we're dealing with the situation on the S&P side where, the VIX is trading at a discount to realized volatility over the last 20 days. 20 and 21 days, pretty rare. Weekend adjusted, probably about even. But needless to say, if you look at kind of where VIX futures are trading and where variance futures, there's some expectation that implied volatility and realized volatility is going to be north of the double digits going forward. And we're not going to be seeing some of those ridiculously low levels that we saw kind of at the first quarter of the year.
Every time the spread between implied and realized, which we know historically is anywhere from about 3 to 5 percentage points, with implied vols being higher, at least on the S&P, gets this way. Every time you touch that kind of rare, as you've mentioned, area where implieds actually dip below realized, you always say, well, that won't last. The norm will be restored, but it's always fun to speculate as to how it will be restored because clearly there are several scenarios. One might be that they actually drift apart with implied rising and realized falling, which would reestablish such a spread. Another might be for realized to stay more or less where it is, but for the options traders to get a little nervous and for implied to go higher. And the third, of course, could be that we maintain the current VIX levels, but we see the market stabilize somewhat and realized start to come in. So given that you probably agree with me that this parity won't last very long and that the norm would be reestablished, I wonder if you've given any thought as to which of those scenarios might play out and how you think that traditional spread of 3 or 4 points might reestablish itself in the weeks to come.
My thought process is probably a little of A and B. I think implied vol probably needs to go a little higher, and realized vol is going to go a little lower.
Yeah, and that doesn't surprise me. I think if I would have guessed, I might have said the same thing. If you think that the market's okay for a while and we might hang out here or even have some sort of an orderly increase, chances are that realize might fall off a little bit. But having said that, it's not at all clear that VIX, which is awfully low, might not tick up a little in the process. And it's unusual to have the market go higher and VIX go higher also, but we've actually seen a couple of instances of that in the last couple of days, and it's possible that we'll see a few more.
Yeah, well, and that is not a bullish sign for the overall market.
Right.
A VIX that is rallying with the market typically points towards some sort of top. In fact, when I look over the last 15, 20 years of my trading, every time we saw volatility start to rally with the market, we saw kind of a push higher and then a nice drop back, be it an equity, be it a commodity, be it an index. That seems to be a pattern that is relatively consistent. Oil, Apple, the tech bubble, the housing bubble, it's the interest rate bubble. Every time we see these type of things, I think they point toward it's something people need to be thoughtful of. If the VIX is at 1385, if S&P movement slows to 9 to 10 points a day, then it's fairly priced. and it should stick here. But if we keep rallying and the S&P starts to rally at 1 to 2%, or 1 to 1.25%, we see the VIX rally to 16, 17% on, kind of a strong rally. That is going to be my. I've been saying S&Ps and NASDAQ, the whole 9 yards, going up, up, up. And that'll be my sign that maybe things are changing. Now, to you, Don, I got to ask, when is this NASDAQ underperformance gonna kind of finally rectify itself? I feel like, NASDAQ's been trailing S&P.
Yeah, I mean, are you talking in terms of the index or in terms of volatility?
A little of both.
Yeah, well, obviously you've made the point over and over again that Apple is such an important component of NASDAQ, and clearly Apple has been experiencing a tremendous amount of difficulty lately. And so obviously in terms of the index itself, that can be a drag on performance. And in terms of volatility, we've noted now for some time that what are historical norms of seeing NASDAQ volatility considerably higher than the S&P have not been the case for quite some time that we've been on the air. And it's kind of interesting to note, although I'm jumping ahead to our last segment, that our friends over at the Volatility Institute, when they forecast on their Garch models longer dated volatility, let's say for the next 12 months or so, they put about a 16.5 handle on the S&P and a 24.5 on NASDAQ, much closer to historical norms. But, you really have to wonder if that's because they use a great deal of historical data, and we haven't seen anything in the near term that has indicated that there would be as much as an 8-point spread volatility-wise in terms of realized volatility between these two indices. So be interesting to see over the year if that type of traditional spread that used to be the case in the relationship of the two will pan out going forward. I haven't seen very much to indicate that it will, although, as I mentioned at the top of the show, NASDAQ has crept ahead by about 3 percentage points right now. There's still a long way to go to 8, so we'll have to keep an eye on it and see what happens. I will make one other comment, Mark. I've often been sort of critical of VIX as a predictor and of, options implied in general as being proactive or forecasting ability rather than reactive. But I take interest in your comments of a moment ago, if we could do some research and actually see that it pans out, because what you're actually saying is that very strong negative 80% correlation between implied volatility, the VIX index, and market movement could, in fact, be breached, where you would have the market moving up, but with your prediction of implied volatility moving up as well, rather than the mindless knee-jerk, the market goes up and implieds go down, as I've alluded to many times. So if there are, in fact, key moments when the market goes up and implieds go up along with it, and it then pans out the majority of the time that the market is in for difficulties from that point on, might be interesting to do a piece of research to kind of verify that, because there you'd have to tip your hat to the options traders and say that maybe they're able to see through some of these rallies and yet not allow implieds to fall as they usually do, and that perhaps they are onto something. So I'll keep an open mind that could potentially be the case. I'd like to see some research on it. It might make for an interesting discussion somewhere down the line.
Yeah, my thought process is less that option traders are smart, and more you get this kind of euphoric upside call buying that starts to run up volatility.
I see.
And that they're wrong. So like Apple was a clear instance of kind of euphoria and a market bubble, because, and I think we talked about this. We saw the skew curve completely shift on an equity. So we saw calls become more expensive than puts. Something similar that we saw, say, in 1999 in the Lycoses of the world and the Excites and the Yahoos,
Yep.
when all this crazy speculation caused upside call buying. And so I actually think it's actually the stupidity of paper that causes implied volatility going up. So it's actually option traders are so wrong that they're right. Does that make sense?
Well, it could. I mean, actually, you bring up a very good point. In my thought process of seeing VIX go higher or implieds go higher, I simply thought of it as a general shift in or translation of the curve where everything is going higher. But if you do have that euphoria and everybody's looking to jump on the bandwagon as the market's going up, and you get this kind of frenzy of call buying, even a one-sided demand that pumps up volatility in the calls, which usually lags so much the out-of-the-money puts and create the skew, would, of course, bump up overall VIX or overall implied volatility, even if it's one-sided. And there, of course, your point is well taken, that it's not so much that the options traders are so savvy in what they're saying. It's just that everybody's making a run on calls, you know?
Right. Right. It's not that they're so smart. It's that they're so dumb.
Well, you made me feel better. Now I feel better.
Yeah. I mean, it's interesting that they're so dumb that it actually becomes a predictor.
Yeah. Well, that's kind of interesting, isn't it?
Yeah, it really is an interesting way to put at it. But that's it.
Hey, listen, I got to tell you something. You know, I used to joke with guys who would try to pick sports and football games and everything. And, you know, the guy would say, you know, I'm just consistently terrible. You know, I always pick around 45%. And I said, you know what? I'm not sure you really mean that. But if you do, just keep it up because, you know, I'll just bet the other way and I'll be picking 55% the whole time. So, you know, if you can get a reliable indicator of somebody who's just consistently wrong all the time, you've got a great indicator there as well. So
yeah,
you just...
I think, you know, Don, one of the things I think is going to be interesting is, you know, Longo and Mark talked about this. Now that they've got these mini options, by the way, is there any irony that they listed all these mini options, and since they listed them, 3 of the 5, you know, 40% of them have taken a complete dive, Apple and Gold. And then almost as soon as, and the other ones have stopped rallying with it. So one thing I'm going to look at is kind of like this mini lot index, as opposed to, like, you know, they used to have the odd lot index.
Yeah, right.
I'm wondering whether there'll be a mini option index that can be informative to us. Now, Don, finally, before we move on to listener questions, I would be remiss if I didn't bring up what happened on CBOE yesterday, where they were unable to trade VIX or SPX options for about 3 hours. And I was, you know, I had people. It was interesting. I got a phone call from a friend at Dow Jones, and I gave him a quote. As usual, this was just happened to be a story that the regular news organizations picked up, like the New York Times and some of these other ones,
sure,
that don't normally follow options. So they saw my name and so my phone starts ringing off the hook. But what the consistent question they kept asking is, how does the inability of VIX trading affect the overall markets? Because, you know, my point was, well, there's alternatives to SPX options, right? Spider options, S&P futures options. Currently, there's no direct alternative to VIX futures or VIX options. And, you know, my comment was that this probably slowed down, you know, unmatched variance swap trades in the over-the-counter market. Your thoughts?
Well, it's a really tough process because obviously when your system breaks down and when you all of a sudden don't have the quotes that you are accustomed to, everybody scrambles to try to find out what the truth is. The world doesn't stop turning because a machine breaks. And so there's this discovery process where everybody is looking to whatever they can possibly look at that's still trading properly in order to try to see where the vehicles that they're accustomed to trading would be if everything were up and running. So I think what you is true. I mean, you scramble to look and see if futures options are still trading, and let's face it, there's certainly an extremely high correlation between S&P options on the futures and options on the cash. So if I were caught in that kind of a situation, feeling very uncomfortable because I didn't have VIX disseminated and I wasn't able to look at S&P cash options and see levels of volatility, I don't know if I would have had programs in place. It may serve people well. Should have programs in place where they can actually have computer programs that will calculate a surrogate for VIX, if you will, off of the S&P futures options to kind of get a look at what's going on there while the systems are down. Now, it may be a whole lot of trouble to try to create something like that for the once in a blue moon that the machines go down. But, that's the type of thing that I would be looking for. Again, the underlying truths don't stop because a computer breaks. And so what you're doing is scrambling during that time period to try to look somewhere to give you a clue as to what things might be if they were up and trading or if the systems were working. So
agreed. And all the major institutions, what do they really, the lessons they've learned over the last couple of years: redundancy.
Yeah, that's for sure. And that's what it preaches. I mean, it's pretty clear that all of the electronic trading, it's pretty clear that all of the systems, are obviously here to stay, and they are what drive the market. But we've had too many instances now of things that go wrong. We just had that whole Twitter nonsense with the AP story and what you've just mentioned. And, of course, don't have to remind anybody of the flash crash and things of that nature. So when things like this happen, everybody tries to determine, A, is it true? And B, if there's an outage or whatever, what do I do for information in the interim until things are restored? So redundancy.
There you go. And, on that note, let's swing out of the Volatility Review and dig into some listener mail.
Listener mail. Listeners write in.
Mailbox.
And here we are with some listener mail, volatility-related questions. The first one is from Phil Z. And he says, Mark, and I think he meant Mark Longo here, but we'll say he meant me. Mark, love the show. Can you explain what you, Don, and Mark S. mean when you say VIX has roll risk? Period. Love the show. You want to tackle this one, or do you want me to do it, Don?
Well, since he said he loves the show, I think we'll answer him. And of course, you can expand on what will be a very short answer for me. But what we're talking about here, whether it's trading volatility futures or any kind of futures contracts, is that obviously futures come with dates associated with them. They expire. You can't buy a futures contract and hold that particular contract forever the way you can a stock. And so whether you're trading options or futures, if you're going to stay in the game, you have to realize that there will come a time when the futures contract that you're holding, let's call it the front month or the nearest one, is going to expire. And if people want to perpetuate their position and hold it beyond the expiration date and into the future, they need to look to the next contract in the series. It might be monthly, it might be quarterly, but whatever that next expiration will be, you're looking at getting out of your front month and acquiring the next month. Some people wait until the very day of expiration, and then they look to roll or get into the next month. Some people look to do that trade earlier on and liquidate their position that they're holding in the front month several days before the expiration date to kind of get a jump on everybody else, if you will, and then look to acquire the next month. So this is the process that's called rolling. And of course, there's a theoretical value associated with each of those futures contracts. There's a value that you should expect to be fair value for each one of them, and therefore you can establish a spread between the two, and you should say that that spread should be trading at a certain level when you go to roll, get out of one and into the other. Problem is that that spread, for all sorts of reasons, doesn't always follow theoretical value, and therefore, as you go from one contract to the other, you have a risk. You have a roll risk that doing that particular trade may wind up costing you more than you expected it to. And so as you do this from quarter to quarter or month to month, you always face the price of that spread or the price of that roll, which isn't always easily predictable, and sometimes it may appear cheap to you, but other times it may appear expensive. So there is a kind of a volatility or a risk in trading the roll every time that it comes up, and this is what we refer to as roll risk.
Yeah, and when one of the issues with kind of VIX itself is that it constantly has this weird contango, and it's much steeper than a normal futures curve.
Yes, it is.
And that makes the roll risk especially problematic for VIX. Now, Don, here's a question, a little off topic, but I think interesting. What would you imagine? So, you guys, if and when the Nasdaq realized vol futures, real vol futures trade,
yep,
which are essentially just kind of which is basically a vol swap.
Correct.
What, since it's a realized trade versus an implied trade, what would you imagine the curve would look like? Would it look like kind of how a Nasdaq variance swap curve looks currently, or how do you think the construction will look?
My feeling is that it's going to be similar, but of course, when you mention the contango and VIX and the steepness that's there, the thing that will somewhat set apart the actual real vol futures is that we know that they are going to settle not to a theoretical value, not to a forecast, not to a guess, but rather to a formula-driven absolute value for realized volatility. And so if you're holding a front-month contract, you will be in what we refer to as the calculation period. In other words, the clock will be ticking, and you will have actually started to input daily returns of the volatility into this particular formula. So you're going to be trading a front month, which is a kind of a hybrid product. Part of its value derives from what has already taken place and what has been logged, if you will, or driven into the formula as an input of realized volatility, but part of the value will be that estimate of future volatility that hasn't taken place yet. Mm-hmm. And that will be the remaining days in the life of that front contract. So you would expect that when you go to trade the spread or the roll, that you have got a kind of a hybrid product for the front month, but you have a purely predictive product for the second month, and therefore that second month may resemble what VIX futures would look like and may resemble what an implied type of contract would be, since the calculation period hasn't started yet. But that being said, there will be a difference in the front month between a pure VIX implied product and a realized product that already has started its calculation period, so that may have an effect on how those spreads trade.
Yeah, like I would imagine that these futures will, instead of trading, like if I look at the NASDAQ option complex, instead of like a VXN futures curve, I would imagine that I would imagine that looking at NDX options would and where May is trading relative to June, rather than a VXN futures where the curve would. So it'll probably track more the direct implied than the futures curve does. If that do you think, or am I off base here, Don?
Well, no, I think that there's a component that's there, but the part that's going to be very interesting to see, and we've put some of this on our website and written a few articles about it and talked about root mean square calculations, and the part that will be already calculated as realized and the part that remains as implied, and kind of the best guess at how the contract will unfold from this date forward. That'll be the interesting point, to see how the traders actually digest this information and use the part that has already been logged into the formula as opposed to the part that remains, and whether they will weight it according to the kinds of calculations that we feel would go into a fair value calculation. I think there will be some sort of a learning curve at the beginning as people start to get a feeling for how the contract trades and how responsive it is to the part that has already been logged into the calculation formula and the part that remains. So I think we're all kind of, done a lot of theoretical studies on this, but since there's no empirical data and since the contract hasn't actually yet traded, and it's really, really hard to get any kind of historical over-the-counter swaps information, especially on volatility. Yes. There's some sketchy stuff on variance, but less on volatility. So try as we may to be as accurate as we can in our articles and in our theory pieces that we've written on the website. Admittedly, it's all done with an eye toward what theoretical value would be, and it's going to remain to be seen when the contracts trade just what the empirical data and the real world trading will bring. I'm kind of interested to see that myself.
Live vol that I'm looking at here, they've got an NDX IV30 of 13.8. So that I would imagine, I would theorize that a NASDAQ real vol future that had exactly 30 days to expiration on the open would begin trading somewhere around that IV30 level that options price at that 30 days, and then start to veer from that as it gets closer to expiration. But some of the longer term contracts would maybe track some of those IV90 and IV120 days. Whereas, if you look at a VIX future versus like SPX, all right, the SPX, live vol's listing the SPX 30-day contract or 90-day contract at call it 14%, and the 90-day contract in the VIX futures are trading almost 16.5.
Right.
So I think that you'll have less of that spread, and if you're looking to actually trade real volatility, real option volatility before it begins this calculation period, you're actually going to get almost a direct hedge for option Vega.
Yeah, and
Futures.
that's what we're hoping. And the point that you bring up is important, and that is, when trade the VIX futures and you look out to the far month, you realize that when you do come to settle that, which is the 1 month before, so the VIX is always forward looking, that you're still in all, not that what has happened with market volatility doesn't matter, clearly it does, but you're still in all always settling to a forecast. So, they can keep levels high as long as they want, just as long as everybody agrees to keep calling it that. But with the real vol futures, everybody will understand that they are going to settle to the actual market volatility. And they are formula driven, and they have to expire at the price that represents the previous 21-day market volatility for that particular period. So that's going to keep that in line, where people are going to look at VIX and say, hey, I see what it says, but, they can do anything they want with this. They can settle it wherever they please. I'm trying to guess where they're going to guess, which, I've tried to stay away from on our shows because I'm not all that good in guessing what other people are going to guess, but I'll take a stab at guessing what actual market volatility is going to be over a particular period of time. So, that's the big difference. And of course, there's a difference in the expirations. We expire at the end of the period and we look back with value, whereas VIX contracts expire and they actually expire to what the prediction is for the forward looking. So you have a little problem there, because if you're looking to compare apples to apples, you have to match up the periods that you're actually discussing to make sure you're talking about the same time frame, which isn't always obvious when you're talking about a backward-looking product and a forward-looking product. So all food for thought.
Yeah, absolutely. This is a question from Tom S. Do you agree with the theory of your guest that near-term S&P out-of-the-money puts are the most resilient to time decay? Now, Don, what the guest had said is that based on how skew currently is moving and where vols were pricing, and kind of how the entire S&P complex looked, at the current juncture, he thought that, his math and his calculations were that you were getting a better hedge and cheaper gamma buying nearer term S&P puts than you were if you'd gone out 6 to 9 months and buying those S&P puts. His point was that relative to realized vol and relative to how expensive the gamma was, that near dated S&P puts were cheaper than the far dated.
Okay.
All right. Now, my comments would be the answer is probably yes and no. There's no way that near-dated options are always going to be the most resilient to time decay, but it can exist. When IV gets really, really, really low. So if you look at the implied volatility of options, there are a lot of things that are going to determine whether a put is a better buy than another put. What does the volatility landscape look like? Are longer dated options a lot more expensive than near dated options? What does the skew curve look like? Is the near term curve flat while the long term curve is steep? What does the entire complex look like? And that's really going to determine where things are cheap and where things are expensive. So I think the guest's point was not that near-term puts are always cheaper than long-term puts. I don't think that's true. But at this current juncture, with where S&P skew is trading and where near-dated and longer-dated options are, that maybe you're getting more bang for your buck in terms of zeta, which is a calculation of gamma to decay, than you are out of your mid-tier and longer-dated options.
Yeah, and it really brings up the fact that when you always come down to something like should I buy this or should I buy the further out one, what you're really considering is whether you would buy the calendar spread or sell it. Because the way I always looked at those trades was, if you buy something right now, let's say you own this nearer term put that he's talking about, to do the alternative would be to sell that one and buy the farther dated one. Well, that would mean that to undo the one that you own, you would be buying a calendar spread. And the question is that something that looks lucrative to you? Is that something that you would want to do or not? And of course, when you graph an options calendar spread, there are always a couple of components to how successful you can be. One of them is how volatility moves, and that's what you've just discussed, which basically has to do with how quickly the volatility of the farther dated one may move up or down with relationship to the nearer one. And we know that different dated options have different vegas. They react to changes in implied volatility differently and not equally. But something that I suspect the guest wasn't referring to is anytime you have that kind of a position, it kind of matters what happens to the market in general. There's a graph. There's a risk graph to owning a calendar spread, and we know that when you're long a calendar spread, if the market moves violently in one direction or another, that can cause some problems. And when you're short, it's just the opposite. It looks a little bit like a long straddle. So that enters into the equation as well, and it's something that will also enter into play when you look at whether or not you would rather own the nearer dated ones or the farther ones. You also have to kind of consider what your market outlook is and whether or not you think the market's going to be relatively stable over that period of time or whether there might be a great deal of movement. I suspect he wasn't relating to that or considering it, but it's something that I always did think about when I thought, do I want this month or do I want that month? Implicitly, what you're really thinking about is what your thoughts would be on the calendar spread itself.
All right. Yeah, I couldn't sum it up better myself, Don. Couldn't agree more. And with that, we'll roll out of listener mail and we'll move into our volatility crystal ball.
And now we take a look at the crystal ball.
And here we are at our crystal ball. This is where Don and I are going to make our brilliant predictions that are almost always half the time right.
Speak for yourself.
And my thoughts are, I think we kind of touched on this in terms of S&P. S&P realized vol really did spike up, and I think it's going to certainly stay more elevated than it was in, let's say, early February when it touched 4.5%. I think it does stay above 10%, but I don't see it sticking, 14, 15, 16%, not when the volatility complex is saying 14% is a fair price. So if you believe in that 2 to 4% range, that places S&P real volatility somewhere between 10 and 12. So right. I'm gonna split the difference and say I think real vol will look at 11% and implied. I don't think we're gonna move very much, and if we do, I think we'll kind of hover toward 14% in VIX.
Well, that sounds like a good call, and I think I'm probably close to your thinking. We're recording this show at about 1 p.m. Central Time on Friday the 26th. And as we look at the markets, they're actually mixed right now. The Dow is up ever so slightly. NASDAQ is down ever so slightly. And so S&P is practically unchanged, down just a couple of points. Resulting VIX is practically nowhere as well, at about 13 and three quarters. So again, we do have that interesting phenomenon where VIX is below actual market volatility. And I think that I would be in your camp, Mark. I think that the way that we resolve that spread and widen it a little bit, with implied being ahead, is that realized actually inches down a little bit, and perhaps VIX stays where it is or goes up a little bit higher. If that were the case, I would say that the reason that realized would fall could very well be either a relatively stable market for a while, or one in which we continue to have modest gains, in which case we, in fact, might see realized come off a little bit. 14% is not quite 16, so it's not 1% daily movement, but it's close to it. And, you know, on days like this, we don't see anything even remotely resembling a 1% move in the underlying. So have a few more days like this, and you're sure to see realized start to drop off. The interesting part will be to come full circle to our beginning discussion. The interesting part will be to see whether, if the market does rise, whether the implied volatilities can nonetheless inch higher with the potential ramifications that you discussed earlier in the show. So these could be interesting times.
Mm-hmm. All right, and with that, we'll wrap up the show. And what's going on at the Volatility Exchange?
Well, I think listeners are starting to probably adopt a healthy dose of skepticism when I say that we're so close to finalizing our deal with a major investment bank to invest and to start the ball rolling to launch our products and market-making efforts and what have you, that we can literally taste it. But the fact is that is the case, and we expect some major news very shortly. So I know listeners have heard this before, but this time it's for real, and we always thought that it was real in the past, but these things move much more slowly than I ever would have dreamed, and it was a good lesson for me to have gone through the process and to see how carefully vetted and how many different departments and areas of a bank get involved with a decision such as this. So it opened my eyes, but at the same point, it kind of dragged things out a little bit longer than all of us expected. So we're on the verge, and I hope to have news, perhaps even by our next show.
Okay, that sounds exciting. And on my end, I'm just going to pump this Options Insider Conference coming up May 15th. I mean, who doesn't want to listen to me talk unedited for 4 hours straight? Can you imagine how much fun that would be, Don?
Just have a few breaks thrown in there.
There you go. Well, a few beers, a few breaks. I think maybe that's the only way you could make that more fun. So
there you go.
And everybody go to theoptionsinsider.com, click on events, register. You get a free copy of my book. You get all kinds of great swag, and you get to glad hand with a handsome young man such as myself. So
what could be better than that?
What could be? It sounds like just a jolly good day. So on that note, we'll call it a day here, Don. Thank you again for being here and being so great as usual. And I'm going to wish
it was terrific to be back, and you did a great job filling in for Mark. We're very appreciative and very happy that you're on the show as a regular. Your insights add a great deal, and thank you for stepping in.
Oh, thank you, Don. I had a pleasure, and I'm looking forward to taking my normal role as the
as the bullpen pitcher next week. So I hope everybody has a great week, and we'll see you next time on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volx Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.